Here's a question that sounds simple but has made serious investors a lot of money over the past 50 years. If you had to pick between gold and silver right now, which one do you buy? Most people answer that instinctively. They go with gold because it feels safer, or they go with silver because it's cheaper per ounce. But neither of those is actually how experienced precious metals investors make the decision. They use a single ratio, one number, that has accurately signaled every major precious metals turning point since 1971. And right now, in April 2026, that ratio just did something it has only done a handful of times in the last 5 decades. Welcome to Money Simplified. Today we are breaking down the gold-silver ratio, what it is, what it has done throughout history, what it is telling us right now, what the bull and bear cases look like from here, and exactly how investors use it to make smarter decisions. By the end of this video, you will have a framework that most people spend years learning, laid out in plain, simple English. Let's start with the basics. The gold-silver ratio is one of the simplest calculations in finance. You take the price of gold per ounce and divide it by the price of silver per ounce. That number tells you how many ounces of silver it takes to buy 1 ounce of gold. That's it. Nothing more complicated than that. Right now, with gold trading around $4,700 to $4,900 per ounce, and silver around $75 to $77 per ounce, the ratio sits at approximately 62 to 64, meaning it takes roughly 63 ounces of silver to equal the value of 1 ounce of gold. Now that number on its own means very little. What makes it powerful is context, where that number has been historically, how it behaves at extremes, and what tends to happen when it moves sharply in either direction. Here's the historical backdrop you need to understand. According to data going back over a century, the long-term average gold-silver ratio across the modern era sits between approximately 60 and 70. Since 1970, the average has been around 60. Since 2000, it has been approximately 69. So a reading of 63 right now sits right around the long-term average, which makes this moment interesting because to get here, the ratio just went through one of the most dramatic round trips in modern financial history. Let me walk you through it. In April 2025, the gold-silver ratio briefly climbed above 100 to 1. That is a level that has only been reached or exceeded a handful of times in modern history. In March 2020, during the COVID-19 market panic, the ratio hit 125 to 1, the highest reading ever recorded in the modern era. In 1991, it reached 100. In 2008, during the financial crisis, it touched around 90. Every one of those extreme readings shared one characteristic. Silver had become extraordinarily cheap relative to gold. And every single time, silver eventually caught up, often dramatically. When the ratio hit 100 in April 2025, investors who understood this pattern had a decision to make. Was silver going to remain that cheap relative to gold, or was a reversion coming? The data at the time pointed clearly to the latter. Silver was running a 5th consecutive year of structural supply deficit. Industrial demand from solar, EVs, and AI infrastructure was at record levels. The physical market was tightening, and the ratio itself was sitting more than 2 standard deviations above its long-term average, a level that had historically proven unsustainable. What happened next was one of the most spectacular precious metals moves in recent memory. Silver surged 147% in 2025. Gold gained an impressive 67% in the same period. Investors who recognized the ratio signal and shifted towards silver more than doubled the returns of those who held gold alone. By early 2026, the ratio had compressed all the way down to approximately 57, a swing of nearly 45 points in less than a year. That is the power of the gold-silver ratio when used properly. Not as a crystal ball, not as a guaranteed signal, but as a relative value indicator that tells you, with reasonable historical reliability, when one metal has become unusually cheap or unusually expensive compared to the other. Now let's look at the broader historical pattern, because this is where the story gets genuinely interesting. In 1980, during the famous Hunt brothers silver squeeze, the ratio collapsed to approximately 17 to 1, the lowest reading in modern history. Silver had become more expensive relative to gold than at almost any other point in the modern era. That marked the top of silver's speculative run. In 2011, silver surged to nearly $50 per ounce on the back of post-financial crisis stimulus and industrial demand. The ratio compressed to around 30 to 32. Again, silver had become relatively expensive. That was another cycle peak. In March 2020, COVID panic pushed the ratio to 125, silver's cheapest relative reading in modern history. What followed? Silver gained over 150% in the next 18 months as the ratio normalized. The pattern that emerges across all of these data points is consistent. When the ratio reaches extreme highs, above 80 to 90, silver has historically been in a position of relative undervaluation, and strong silver performance has followed. When the ratio reaches extreme lows, below 40 to 50, gold has tended to offer better relative value going forward, and silver's gains have typically stalled. The ratio is not perfect. It doesn't tell you exactly when a move will happen. Investors who bought silver when the ratio hit 80 in 2018 waited 2 full years before the trade paid off. The 2020 spike to 125 was genuinely extreme and presented one of the great precious metals opportunities of this generation, but only in retrospect. Living through it in real time required conviction and patience. But the directional signal over time has been remarkably consistent. High ratio means silver is cheap relative to gold. Low ratio means silver has caught up. Knowing where you are in that cycle is more valuable than almost any other single piece of information in the precious metals market. So where does that leave us right now in April 2026? The ratio is sitting at approximately 62 to 64. As goldsilver.com noted in their April 2026 analysis, with gold at $4,750 and silver at $72.55, the ratio sits at approximately 64, meaning the metal is no longer obviously cheap relative to gold the way it was at 100 in 2025. The massive undervaluation signal that existed 12 months ago is no longer present. Silver has already repriced significantly. That doesn't mean the story is over. It means the easy, obvious opportunity has passed, and what comes next requires more nuance. Let's look at both the bull case and the bear case for the ratio from here. The bull case for further silver outperformance, meaning the ratio continues to fall below 60, rests on 3 pillars. First, industrial demand. Silver's industrial consumption in 2024 hit a record 680 million ounces. AI data centers, electric vehicles, solar panels, and grid infrastructure are all consuming silver at rates that were unthinkable 5 years ago. Gold does not have this industrial demand anchor. If the global economy stays resilient despite the Iran war headwinds, silver's dual identity, part monetary metal, part industrial necessity, gives it an engine that gold simply doesn't have. The Silver Institute projects 2026 as the 6th consecutive year of supply deficit. Second, the monetary backdrop. If the Federal Reserve pivots toward rate cuts in the second half of 2026, real yields fall, the US dollar weakens, and non-yielding assets like precious metals become more attractive. In that environment, silver historically outperforms gold because it captures both the safe haven bid and the industrial demand recovery. A ratio compression from 64 toward 50 in that scenario would imply silver at approximately $90 to $95 per ounce if gold holds around $4,700. Third, the geological reality. Earth's crust contains silver approximately 17 times more frequently than gold by weight. Yet the market ratio has averaged 60 to 70 for decades. Over long cycles, many analysts argue that silver remains structurally undervalued relative to this natural abundance ratio, a position that would compress further if supply deficits persist. Now the bear case, meaning the ratio rises back toward 75 or 80, implying gold outperforms from here. The most significant risk is the macro environment. The Iran war that began in early 2026 has created the largest oil supply disruption in modern energy market history. Rising oil prices have reignited inflation, pushed bond yields higher, and strengthened the US dollar. That is the exact environment where silver traditionally struggles. Higher real yields raise the opportunity cost of holding non-yielding silver. A stronger dollar makes silver more expensive for foreign buyers, suppressing global demand. Furthermore, silver's industrial demand is not as bulletproof as the bull case sometimes implies. Solar panel manufacturers are actively reducing silver content per cell through a process called thrifting. Companies like Longi, Jinko, and Ico Solar have launched copper-based alternatives. PV silver demand is actually forecast to fall 19% in 2026 to approximately 151 million ounces, a real headwind to the pure industrial demand story. And at a ratio of 62 to 64, silver is no longer the screaming undervaluation it was 12 months ago. The LBMA Analyst Survey for 2026 shows forecasts ranging from $40 to $165 per ounce, the widest range ever recorded for silver, which reflects just how uncertain the forward picture is. TD Securities, the most bearish institutional voice, has a 2026 average forecast of $44 per ounce. A move to those levels from current prices of $75 to $77 would push the ratio back above 100, potentially recreating a buying signal, but only after a very painful correction. So what is the practical framework? How do serious investors actually use the gold-silver ratio? Here is the approach that has the most historical backing, based on data from Bullion, USAGOLD, goldsilver.com, and decades of precious metals research. Think of the ratio in 3 zones. The first zone is above 80. This is where silver is historically cheap relative to gold. Investors who want precious metals exposure are generally better served overweighting silver in this zone. Not because silver is guaranteed to outperform, but because the odds historically favor it. The 80-plus zone has repeatedly represented an opportunity to accumulate silver against gold. The second zone is between 50 and 80. This is the long-term normal range. Both metals are fairly priced relative to each other in historical terms. In this zone, allocation between the two comes down to your personal view on macro conditions, industrial demand, and risk tolerance, rather than ratio-driven signals. At 62 to 64 today, we are in this zone. The third zone is below 50. This is where silver has become historically expensive relative to gold. Investors who accumulated silver at high ratio levels and rode the compression may want to consider rebalancing back toward gold. The 2011 ratio of 30 to 32 and the 1980 ratio of 17 are examples of what this zone looks like at extremes. Where are we today? In the middle of the normal range. The extraordinary signal that existed in 2025 has been used. The market has already done a large portion of the mean reversion work. That doesn't mean silver can't continue to outperform. But it does mean the easy part of the ratio trade is behind us, and any continuation from here depends more on macro forces, rate policy, dollar direction, industrial demand data, than on the ratio itself signaling obvious undervaluation. The 3 things to watch going forward are these. First, watch the Federal Reserve. If Kevin Warsh, the newly nominated Fed chair, signals a hawkish framework and real yields stay elevated or rise, the ratio will likely expand back toward 70 to 80, and gold will outperform. If the Fed pivots toward cuts and real yields fall, the ratio is likely to compress further toward 50, and silver will outperform. Second, watch China's industrial demand. China's silver imports hit an 8-year high in early 2026. If that continues through the year, silver's industrial floor is real and meaningful. If the Iran war-driven economic slowdown hits Chinese manufacturing hard, that demand cushion erodes faster than the bulls expect. Third, watch the ratio itself. If it rises back above 75, that starts to rebuild the undervaluation case for silver. If it falls below 55, that starts to signal silver is becoming relatively expensive again, and gold may offer better value. These are not precise trading signals. They are context. Use them as one input among many. Let me bring this home with the most important thing I want you to remember from this video. The gold-silver ratio is not a secret weapon. It is not a guaranteed signal. It is not a shortcut. What it is a 50-year track record of providing reliable directional context about relative value between 2 metals that billions of people hold as stores of wealth. Investors who understood the ratio when it hit 125 in 2020 and had the conviction and patience to act on it were eventually rewarded with extraordinary gains. Investors who tried to use it as a precise timing tool were often frustrated by how long the ratio stayed at extremes before reverting. Right now, at 62 to 64, the ratio is telling you that the relative value gap between gold and silver has largely closed. It is not screaming buy silver. It is not screaming buy gold. It is sitting in the normal range, waiting for the next macro shift to give it a new direction. That shift will come. It always does. And when the ratio moves toward an extreme again, whether toward 80 or 90 on the high end, or toward 40 or 30 on the low end, you will now know exactly what to do with that information. One final reminder. Everything in this video is for educational purposes only. I am not a financial advisor, and nothing here is financial advice. Before making any decisions about gold, silver, or any other investment, please speak with a qualified financial professional. Precious metals are volatile. past patterns do not guarantee future results. If Money Simplified helped you understand one of the most important tools in precious metals investing today, hit that like button. It genuinely helps more people find content like this. Next, we are breaking down how to actually buy gold and silver in 2026. Physical, ETFs, mining stocks, the pros, cons, costs, and what Wall Street doesn't tell you. Subscribe so you don't miss it. See you in the next one.